Let me tell you something that most retail investors will never hear about until it is far too late. Over the past few months, I have been quietly, systematically, and deliberately exiting three of the most popular stocks in America. Stocks that millions of everyday investors own in their retirement accounts. Stocks that financial advisors recommend without hesitation. Stocks that have become so embedded in the American investment psyche that questioning them feels almost unpatriotic. And I am getting out now. I want you to understand something about how I operate. I have spent over 3 decades in the financial markets. I built one of the most successful hedge funds in history. We manage hundreds of billions of dollars. We employ some of the most brilliant mathematical minds on the planet. We have access to data and analysis that the average investor cannot even imagine exists. And when someone like me starts selling, it is not because I woke up one morning feeling pessimistic. It is because the data, the analysis, and the patterns are telling me something that the broader market has not yet recognized. The positions I am about to discuss are not small adjustments. These are substantial exits from stocks that, on the surface, look like they should be held forever. And I am going to explain exactly why I am getting out, what I am seeing that others are missing, and why you need to pay very close attention to what happens next. But first, let me take you back to a moment that shaped how I think about risk and timing. It was 2007. The housing market was roaring. Everyone was making money. Banks were lending to anyone with a pulse. And the smartest people on Wall Street were telling themselves that the good times would never end. I remember sitting in my office in Chicago, looking at the data coming across our screens and feeling deeply uncomfortable. Not because anything had gone wrong yet. Everything looked perfect. That was exactly the problem. You see, when everything looks perfect, when there are no visible cracks, when every metric is hitting all-time highs, that is precisely when you need to be most cautious. Because markets do not crash from positions of obvious weakness. They crash from positions of apparent strength. They crash when everyone is convinced that nothing can go wrong. They crash when the last skeptic has finally capitulated and bought in. In 2007, I started reducing our exposure to financial stocks months before the crisis became obvious. People thought I was crazy. They said I was leaving money on the table. They said the fundamentals were strong, but I was not looking at the fundamentals everyone else was looking at. I was looking at the second and third order effects. I was looking at the leverage ratios that were not being reported. I was looking at the correlation risks that nobody wanted to talk about. And I was looking at the behavioral patterns that always precede major market dislocations. That experience taught me something invaluable. The time to sell is not when everyone agrees with you. The time to sell is when everyone thinks you are making a mistake. And right now, as I exit these 3 popular stocks, I am hearing the same chorus of disagreement that I heard in 2007. Let me explain how I approach these decisions, because understanding the process is just as important as understanding the conclusion. At our firm, we do not make investment decisions based on gut feelings or hunches. We build quantitative models that analyze thousands of variables across global markets. We have teams of researchers who spend their entire careers studying specific sectors and companies. We run scenario analyses that model dozens of potential futures. And most importantly, we constantly challenge our own assumptions. Every investment thesis we develop has to survive intense scrutiny from people whose job is to find flaws in our thinking. If someone can poke a hole in our reasoning, we need to know about it before the market teaches us the lesson the hard way. This process is brutal and often uncomfortable, but it is why we have survived and thrived for decades, while so many others have blown up. When I tell you that I am exiting these 3 stocks, it is not a casual opinion. It is the conclusion of months of rigorous analysis, debate, and refinement. The concerns I am about to share have been stress-tested against every counterargument we could find. Let me start with the first stock I am exiting, and this one might surprise you the most. I am significantly reducing my position in Tesla. Now, before you dismiss this as just another bearish take on a company that has proven the skeptics wrong countless times, let me explain what I am actually seeing. Because this is not about whether electric vehicles are the future. They absolutely are. This is not about whether the company makes good cars. They certainly do. This is about valuation, competition, and the mathematics of market share erosion. When I look at Tesla today, I see a company that is priced for absolute perfection in a world that is becoming increasingly imperfect for their business model. The stock trades at multiples that assume Tesla will not only dominate electric vehicles, but will somehow maintain profit margins that defy everything we know about how competition works in the automobile industry. Let me take you back to the history of the automotive industry, because understanding history is essential to understanding the future. In the early 1900s, there were dozens of car manufacturers in America. Most people today could not name a single one of them except Ford. What happened? Competition happened. The industry consolidated. Margins compressed. Scale advantages determined winners and losers. The companies that survived were not necessarily the innovators. They were the ones who could manufacture at the lowest cost and sell at volumes that supported their infrastructure. This same pattern has played out in every industry throughout economic history. Early leaders with technological advantages get copied. Fast followers with better cost structures catch up. Margins compress to industry averages. Differentiation becomes harder to maintain. The only exceptions are companies with truly insurmountable moats, and those are extraordinarily rare. Let me walk you through the numbers that concern me about Tesla. The company currently commands a significant premium over traditional automakers, trading at price-to-earnings ratios that are multiples of what Ford, General Motors, or Toyota trade at. The market is essentially saying that Tesla will grow into those valuations over time. But here is what the market is missing. Every major automaker on the planet is now fully committed to electric vehicles. This is not speculation. This is hundreds of billions of dollars in announced investments. Volkswagen has invested over $100 billion in electrification. Ford is transforming their entire product lineup and building dedicated electric vehicle factories. Hyundai and Kia are producing electric vehicles that are winning awards and gaining market share rapidly. BMW, Mercedes, and Audi are flooding the luxury electric market with compelling alternatives. And perhaps most importantly, Chinese manufacturers like BYD are producing electric vehicles at price points that Tesla simply cannot match. I have studied the automotive industry extensively, and one thing I know with certainty is that sustained premium pricing in automobiles requires either brand cachet that takes generations to build, like Ferrari or Porsche, or technological advantages that competitors cannot replicate. Tesla had the technological advantage for years. That advantage is evaporating rapidly. The battery technology gap has closed dramatically. 5 years ago, Tesla's battery technology was years ahead of competitors. Today, the difference is measured in months, not years. The companies supplying battery cells, California TL and LG and Panasonic, sell to everyone. The proprietary advantages Tesla once held in battery chemistry and pack design have been largely replicated. The charging infrastructure advantage is being eroded as every major network expands. Electrify America, built by Volkswagen, now covers most of the country. Ford and GM have adopted Tesla's charging standard, which means their customers will have access to the same network. The charging moat is disappearing. The software differentiation, while still meaningful, is no longer the insurmountable moat it once appeared to be. The promise of full self-driving has been pushed back year after year. Meanwhile, competitors have caught up in driver assistance features. Waymo is actually running fully autonomous vehicles in multiple cities without anyone in the driver's seat. Tesla's software advantage is real but narrowing. What concerns me most is the margin compression we are already seeing. Tesla has been forced to cut prices repeatedly to maintain volume. Each price cut flows directly to the bottom line. In the first quarter of this year alone, Tesla cut prices multiple times across their lineup. Gross margins have fallen from the high 20s to the mid-teens. And in a commoditizing market, the company with the lowest cost structure wins. That company is not Tesla. That company is BYD, which produces batteries internally, manufactures in the lowest cost regions, and operates with structural advantages that took decades to build. I also want to address the China risk that few analysts discuss. Honestly, Tesla generates a substantial portion of its revenue and profit from China. The geopolitical environment between the United States and China is deteriorating. Chinese consumers are increasingly nationalist in their purchasing decisions. The Chinese government is actively promoting domestic electric vehicle champions. Tesla's position in China is not secure, and any disruption there would be devastating to the investment thesis. There is another factor that concerns me deeply, and that is the management focus issue. The CEO is juggling multiple companies across multiple industries, running a social media platform, running a rocket company, running a brain implant company, running an artificial intelligence company, and somewhere in there running a car company. The most successful companies I have studied over my career have had obsessively focused leadership. That focus is simply not present here. I am not saying Tesla will fail. I am saying that at current valuations, the stock is pricing in a future that requires everything to go perfectly. And in my experience, when you need everything to go perfectly, something eventually goes wrong. The second stock I am quietly exiting might be even more controversial. I am reducing my substantial position in NVIDIA. Yes, NVIDIA, the darling of the artificial intelligence revolution, the company that has produced returns that made early investors wealthy beyond imagination. The stock that everyone believes is the one must own position for the next decade. Let me explain why I am getting cautious, and I want to be very precise about this because the nuances matter first. Understand that I am a believer in artificial intelligence. The transformation happening in computing is real and profound. The demand for GPU computing power is genuine. NVIDIA has built an exceptional company with technology that is years ahead of competitors in many applications. Jensen Huang is one of the most capable executives in technology. All of that is true, but none of that matters if it is already priced into the stock. Let me tell you a story about another company that was once the undisputed leader in its space with technology nobody could match. It was the early 2000s, and the company was Cisco Systems. Cisco provided the routers and switches that powered the internet. Every company needed Cisco equipment. There was no substitute. The growth was exponential. The stock was priced for that growth to continue forever. In March of 2000, Cisco was the most valuable company in the world. The stock traded at over 200 times earnings. Analysts argued that traditional valuation metrics did not apply because the internet was changing everything and Cisco was the essential infrastructure. Within 18 months, Cisco stock had fallen over 80%. Not because the internet was a fad. The internet continued growing, not because Cisco was a bad company. Cisco remained profitable and continues to be a good business today, but because the valuation had priced in decades of growth that simply could not materialize at those rates. Today, nearly 25 years later, Cisco stock remains below its 2000 peak. Investors who bought at the top and held are still underwater. Not because they were wrong about the internet, not because they were wrong about Cisco's importance, but because they paid too much. When I analyze NVIDIA today, I see uncomfortable parallels. I see a company trading at valuations that assume the artificial intelligence boom will continue uninterrupted for years, that margins will remain at historically unprecedented levels, that competition will never meaningfully emerge, and that customers will never find alternatives to NVIDIA's expensive chips. Let me challenge each of those assumptions one by one. The artificial intelligence boom is real, but booms have cycles. Every technology revolution in history has gone through periods of massive investment followed by rationalization. The dot-com era saw companies throw money at internet infrastructure before the correction of 2000 and 2001. The cloud computing boom saw similar dynamics. What I am seeing now in AI spending is reminiscent of those earlier cycles. Companies are investing heavily, but many are not yet seeing returns that justify the investment. I have talked to executives at major corporations about their AI investments. The common theme I hear is uncertainty about return on investment. They know they need to be in AI. They are afraid of being left behind. Few can articulate clear, quantifiable returns from their AI spending. That is the hallmark of a bubble in its later stages, spending driven by fear of missing out rather than clear economics. The big cloud providers, Amazon, Microsoft, and Google, are NVIDIA's largest customers. They are also some of the smartest technology companies in history. Do you think they are comfortable being dependent on a single supplier for their most critical infrastructure? They are all developing their own custom chips. Amazon has Trainium and Inferentia. Google has TPUs that are now in their 5th generation. Microsoft is developing custom silicon. Apple has shown the world that vertical integration in chips creates enormous value. These custom chips do not need to be better than NVIDIA's for every application. They just need to be good enough for the specific workloads these companies run, and they are getting there. Each generation closes the gap further. Within a few years, the largest customers for NVIDIA chips will have viable internal alternatives for significant portions of their compute needs. NVIDIA's margins are at levels that are simply unsustainable in a competitive market. Gross margins above 70% in semiconductor manufacturing are extraordinary. They attract competition like honey attracts bears. AMD is investing billions to close the gap, and their latest chips are closing the performance gap while being priced significantly lower. Intel, despite their struggles, is not giving up and has hired some of the best chip designers in the industry to mount their comeback. And the Chinese, cut off from advanced NVIDIA chips by export restrictions, are throwing unlimited resources at domestic alternatives. There is another factor that few people discuss, but that concerns me deeply: the concentration of AI spending in a handful of companies. The majority of NVIDIA's revenue comes from perhaps a dozen large customers. If any of those customers reduces spending, shifts to alternatives, or faces their own financial pressures, NVIDIA's growth story changes dramatically. I have seen this pattern before with Cisco: the customer concentration, the irreplaceable product, the explosive growth that seemed guaranteed, the valuation that priced in perfection, and then the correction that humbled everyone who thought they were geniuses. I am not predicting that NVIDIA will follow the same path. I am pointing out that when stocks are priced for perfection, the risk-reward becomes unfavorable. At current valuations, even if NVIDIA executes flawlessly, the upside may be limited, because so much good news is already embedded in the price. But if anything goes wrong, the downside could be severe. The third stock I am exiting is perhaps the most widely held stock in America, and questioning it feels almost heretical. I am reducing my position in Apple. Now, let me be very clear about something. Apple is one of the greatest companies ever created. The ecosystem they have built is remarkable. The brand loyalty is unparalleled. The cash generation is extraordinary. Tim Cook has proven himself to be an exceptional operator. I have an enormous respect for what Apple has accomplished. Great companies do not always make great investments at every price, and the price matters enormously. This is perhaps the most important lesson in investing that most people never learn. The quality of a company and the quality of an investment are two different things. You can buy a great company at a terrible price and lose money. You can buy a mediocre company at a great price and make money. What matters is the relationship between what you pay and what you get. When I look at Apple today, I see a company facing challenges that the market is not adequately pricing. Let me walk through my concerns in detail. First, the iPhone business, which remains the core of Apple's revenue, is maturing in ways that investors do not fully appreciate. Smartphone penetration in developed markets is essentially complete. Everyone who wants an iPhone already has one. Growth now comes primarily from upgrade cycles, and those cycles are lengthening because the improvements from one generation to the next are increasingly incremental. Think about your own behavior with your iPhone. Think about the last time you upgraded. How different was your new phone from the one you replaced? For most people, the differences are marginal. The cameras are slightly better. The processor is slightly faster. The screen is marginally improved, but nothing about the new phone fundamentally changes what you can do with it. That dynamic pressures both volume and pricing power. I have analyzed the iPhone upgrade cycle data extensively. The average replacement cycle has lengthened from about 2 years to over 4 years. People are keeping their phones longer because the phones last longer and the improvements are smaller. This is a structural headwind that will not reverse. Second, the services business, which has been the growth engine in recent years and the primary justification for Apple's premium valuation, is facing its own challenges. Apple extracts a 30% commission from App Store purchases, a practice that is under regulatory assault around the world. The European Union has already forced Apple to allow alternative app stores and alternative payment mechanisms. This directly attacks the services revenue model. Lawsuits in the United States continue, and the Epic Games case has revealed internal Apple documents that do not reflect well on the company's practices. Regulators in Japan, South Korea, and elsewhere are taking similar actions. At some point, those commissions will come down. The question is not if, but when and by how much. And that directly impacts one of Apple's highest margin revenue streams. The market is not pricing this risk appropriately because it has not yet manifested in the numbers. But the regulatory momentum is clear. Third, and this is what concerns me most, China. Apple generates roughly 20% of revenue from China. The geopolitical situation between the United States and China is deteriorating, not improving. Every passing year brings new tensions, new sanctions, new restrictions. This environment creates risk for any American company dependent on Chinese consumers and Chinese manufacturing. Chinese consumers are increasingly nationalist in their purchasing decisions. I have studied consumer sentiment data in China extensively. The preference for domestic brands has increased dramatically over the past 5 years. Huawei has made a remarkable comeback, producing flagship phones with domestically designed chips that compete directly with the iPhone. BYD and other Chinese phone makers are gaining share rapidly. I have watched the trajectory of American consumer brands in China over the past decade. The trend is not encouraging. What was once seen as aspirational is increasingly viewed with suspicion or even hostility. Apple remains strong in China today, but the momentum is shifting, and in markets where momentum shifts, it often shifts faster than anyone expects. Fourth, the growth initiatives that are supposed to drive Apple's next chapter are either struggling or overhyped. The Vision Pro, while technically impressive, has found limited adoption. At $3,500, it is a niche product that cannot move the needle for a company of Apple's size. The automotive project has been repeatedly scaled back and delayed, and recent reports suggest it may be abandoned entirely. Artificial intelligence, which is transforming the technology industry, is an area where Apple appears to be behind. The partnership with OpenAI for iOS 18 is essentially an admission that Apple could not develop comparable capabilities internally. For a company that prides itself on vertical integration and controlling the entire user experience, outsourcing a core technology to a competitor is telling. When I put all of this together, what I see is a company that, despite its exceptional qualities, is likely to grow earnings in the mid-single digits annually over the next 5 years. Yet the stock trades at a premium multiple that implies much higher growth. The math does not work. Now, let me explain why I am sharing all of this with you, and let me be direct about my motivations. It is not because I want to cause panic. It is not because I am shorting these stocks and trying to talk them down. It is because I believe that retail investors deserve access to the same type of analysis that institutional investors use. The financial industry is not set up to give you honest assessments. Your broker makes money when you trade, so they encourage activity. Your financial advisor often makes more money putting you in certain products, so their recommendations are conflicted. The analysts who cover these stocks work for firms that want investment banking business from these companies, so their research is inherently compromised. When was the last time you saw a major Wall Street analyst put a sell rating on Apple or Nvidia or Tesla? It almost never happens. Not because these stocks are always buys, but because the institutional incentives discourage honesty. Analysts who are too negative get cut off from management access. Their firms lose banking mandates. Their careers suffer, so they stay positive, and retail investors suffer the consequences. I operate differently. I have no banking relationships to protect. I have no career considerations that prevent me from being honest. My only job is to generate returns for my investors. And that requires being right about where markets are going, not where they have been. Let me also talk about what I am doing with the capital. I am freeing up from these positions because simply selling is not an investment strategy. You need somewhere for that money to go. I am finding more attractive opportunities in sectors that are out of favor. Energy infrastructure, despite the narrative around renewable transition, remains critically underinvested. The world needs oil and gas for decades to come, and the companies that produce and transport those commodities are trading at valuations that imply permanent decline. That is a mispricing I am happy to exploit. I am also looking at healthcare, particularly companies that are developing solutions for the diseases that will affect aging populations around the world. The demographic wave of baby boomers moving through their 70s and 80s will create massive demand for healthcare services and products. Companies positioned to serve that demand are trading at reasonable valuations while the market obsesses over artificial intelligence. Financial services, particularly regional banks that survived the crisis of last year, offer interesting opportunities. They are trading at discounts to book value, they are generating real earnings, and they are buying back stock at attractive prices. The negativity around the sector has created opportunities for patient investors. There is one more thing I want to address, and it is perhaps the most important thing I will say today. I want to talk about the psychology of selling. Selling is hard, much harder than buying. When you buy a stock, you feel optimistic and smart. You can imagine all the ways it will go up. When you sell a stock, especially one that has been a winner, you feel doubt and fear. What if it keeps going up? What if you are wrong? What if you miss out on more gains? These feelings are natural. They are also dangerous because they cause investors to hold positions far longer than they should. They cause investors to ride winners all the way back down. They cause investors to confuse past returns with future returns. I have trained myself over 30 years to overcome these feelings. I have learned to sell when the analysis says sell, regardless of how it feels. I have learned that the discomfort of selling is often a signal that I am doing the right thing, because if everyone felt comfortable selling, everyone would sell, and the opportunity to exit at good prices would disappear. Let me leave you with a final thought. The greatest investors I have known, and I have known many of them personally, share a common trait. They are willing to be different. They are willing to sell when everyone is buying. They are willing to buy when everyone is selling. They are willing to look foolish in the short term to be proven right in the long term. Being different is uncomfortable. When you sell a stock that keeps going up, you feel stupid. When you buy a stock that keeps going down, you feel scared. Those feelings are precisely why most investors underperform. They cannot tolerate the discomfort of being different. I have learned to embrace that discomfort. I have learned that the feelings of stupidity and fear are often signals that I am doing something right. Because if an investment decision feels easy and comfortable, it means you are probably doing what everyone else is doing. And if everyone is doing the same thing, the opportunity has already passed. The positions I am exiting, Tesla, Nvidia, and Apple, are the most comfortable positions an investor can own today. They are the stocks everyone owns. They are the stocks that have worked. They are the stocks that financial advisors recommend without hesitation. Selling them feels wrong. That feeling is precisely why I am selling. The markets will do what they will do. I cannot predict short-term movements. Perhaps these stocks will continue higher for months or even years. Perhaps I will be proven wrong. That has happened before and will happen again. But I am playing a long game. I am positioning for what I believe will happen over the next 3 to 5 years, not the next 3 to 5 months. And over that horizon, I believe the risk-reward in these popular names is unfavorable, while the risk-reward in ignored, undervalued, out-of-favor sectors is highly attractive. The choice of what to do with this information is yours. You can dismiss it as the ramblings of a hedge fund manager who has lost his edge. You can ignore it because it conflicts with what you want to believe, or you can consider it carefully. Examine your own positions honestly, and make decisions that are right for your situation. Let me share one more observation before I close. The retail investor base in these stocks has changed dramatically over the past few years. The rise of zero-commission trading, of social media investing, of meme stock culture, has brought millions of new investors into the market. Many of them have never experienced a real bear market. They have been conditioned to believe that stocks only go up, that every dip is a buying opportunity, that diamond hands always win. That is not how markets work. Markets cycle. They overshoot to the upside and correct to the downside. They punish excess and reward caution. Eventually, the investors who have bought these popular stocks over the past few years, who have doubled down on every decline, who have been rewarded for that behavior. They are sitting on positions that could cause them real financial harm if the trends I am seeing play out. I remember talking to a young trader in 2000 who had never seen a down market. He was convinced he had figured out something that older investors had missed. He was leveraged to the hilt in technology stocks. 6 months later, he had lost everything. He had to start over from zero, not because he was stupid, he was actually quite smart, but because he had mistaken a rising market for investing skill. I am not telling you to panic sell. Panic is never a good investment strategy. What I am telling you is to think critically about your positions, to ask yourself whether you own these stocks because of a careful analysis of their future prospects, or because everyone else owns them and they have gone up in the past. To consider whether your portfolio is appropriately diversified or whether you have concentrated bets that could hurt you badly if things change. The markets have a way of humbling everyone eventually. I have been humbled many times in my career. The key is to survive those humbling moments with enough capital and tact to take advantage of the opportunities that always emerge from the wreckage. Whatever you decide, I hope you will remember one thing. The best time to prepare for a storm is when the sky is clear. The time to reduce risk is when everything feels safe. The time to question consensus is when agreement is overwhelming. By the time the problems become obvious, it is too late. The positions have already moved. The opportunity to act has passed. I have seen this cycle play out many times over 30 years, and I am seeing the warning signs again. Now that is why I am quietly, systematically, and deliberately exiting these 3 popular stocks. The warning signs are flashing. Whether you choose to see them is up to you.